Hey guys, how's it going? I'm Lewis Harding Investor and welcome back to my YouTube channel. And in today's video, I'm going to be going through how I analyse stocks using my 4 pillars of stock investing. I have developed this over the past couple of years after studying investors such as Warren Buffett, Vitaly Katzenelson and Tom Gaynor, plus many others, also on YouTube and not in the media, etc. I've just developed this over the years from reading books, listening to podcasts, taking notes, and I've really condensed this down into what I think is a great, short, easy way to analyse stocks. You can always go and analyse more, but I think what this process does is it simplifies it, so you can analyse a stock within, let's say, 15 minutes, and then if you wanted to do further analysis, you can do so, of course. But anyway, yeah, so let's get into this video. I'm really excited to get on with this because I've been wanting to reveal for a long time how I go through my stocks. So yeah, let's get right into it. This is not a recommendation. This video should be seen as a source of information and education only. Please seek a regulated financial advisor if you are unsure of any investment. Yeah, I just want to say that I'm not an expert in stock picking. I've only been doing this for the past couple of years, and you got to take everything with a pinch of salt, to be honest. I have done my own research. I have read all the investing books. I have listened to the podcasts and audiobooks. Watched plenty of YouTube videos as well. There's many good YouTube channels out there, such as Sven Carlin, Learn to Invest, Pensioncraft and Everything Money. So they're the 3 links on my channel anyway, but there's many more, and there's honestly, you can get all this content for free, and this is the way forward for me. I always advise watch other YouTube channels as well and get different opinions on different things, because everyone does think differently at the end of the day. And you've got to remember that investing is an art and not a science. Nothing is definite investing, and a lot of it is down to opinions. Anyway, yeah, so let's get on to the 4 pillars of stock investing. So I have got another YouTube video which I recommend you watch before carrying on with this video, which is the 4 pillars of stock investing. So these are the 4 main things I do before buying a stock. 4 things I look for / do before buying a stock. So yeah, the first pillar is the company has to be profitable, it has to have high returns on capital, and it has to do this by using low amounts of leverage, so low amounts of debt. The second pillar is, does the management, the people running the company, do they have equal talent and integrity? Are they good people? Do they have the best interests in the company? Pillar 3 is reinvestment opportunities and room to grow. So what I do in this pillar is I look at revenue growth, cash flow growth, profit growth. And in terms of like the reinvestment opportunities, I look at the dividend history and dividends paid, share buybacks and acquisitions throughout the company's history. And the 4th and most important pillar of all, buy at a fair price. And this entails looking at the PE ratio, looking at the price to cash flow ratio, and then ultimately the most important bit, which is the discounted free cash flow valuation. So now that I've gone through the 4 pillars of stock investing, and now I'm going to sit down with you and go through each pillar individually and what I look for, broken down bit by bit. The company I'm going to be using for the stock analysis is Alphabet, so Google. So yeah, let's get right into the stock analysis. So as you can see, I'm now sat at my desk. I'm about to go through the process I go through when looking at stocks for the first time. The tools I'm going to be using are going to be Morningstar, Macrotrends, Market Screener potentially in this video, and then Yahoo Finance. All of these tools will get the info I need to be able to analyse stocks the way I do it. Anyway, let's get on to pillar 1. So the company has to be profitable, high returns on capital, and using low leverage. Pretty simply for me, I want companies which are making money. Might sound pretty simple, but some people like to invest in stocks which don't make money. I don't get it. Hey ho. High returns on capital, high returns on equity, return on investment, all means the same thing. How much money is the company making based on what equity they've got in the business? And then low leverage, pretty simple to understand. I like companies with low debt. It's rare to find a company with 0 debt, but the lowest debt is possible, because the more debt you have, the more fragile you are. Yeah, so now moving on to what I actually look for. So I'm now on Morningstar. What I'd usually do looking at a company is I will go through their financial statements on Morningstar, because it just breaks it down very simply and very easily. So the first one will be the income statement. So this is the profit or loss, what the sales are, minus what the costs are, then you get your profit. So having a glance over at Google, you can see that the revenue is just growing pretty consistently. It's a growing business, even though it's a large business. And then you can see down here, net income, you can see that the company is making decent profit. And then what I would do is I would just have a general look at the balance sheet. Just let it load quickly. It breaks it down, assets, liabilities, and then equity. So yeah, you can see everything for Google here. Yeah, you can see we've got a lot of money. Anyway, we'll get onto that. But yeah, anyway, now moving on to what I look for in pillar one. So the first one will be profit margin. What's important for me when looking at a company is what profit margins do they have. I personally like companies with a net margin of at least 10%. I usually like a gross margin of 40% or above, because this shows the company must have pricing power and a competitive advantage. For me, net margin is the most important because this is the bottom line, what the company is physically receiving as profits. So I like companies with 10% or above. But one thing I do mainly look for is their profit consistent? So if there's a company, let's say Walmart, for example, this is a great example. So their net margins are always like 1 or 2%, but their sales are like 500 billion. So because of their business model, their margins are very small, but because they are who they are, they still make a lot of profit. You just have to take everything with a pinch of salt, like I say, it's not a science. But generally, look for companies with 10% profit margins. So now I'm just on here on Morningstar and I'm looking at the net margin of Google 2016, 22%. And just looking 2017, 11, 2018, 22, 2019, 21, 2020, 22. Fantastic. Tick mark for Google on this one. Very simple. And then the next one is return on equity. So I think I mentioned before, return on equity is the money they make on what's invested in the business, the returns on what equity is within the business. And I always aim for 15%. That is kind of a very golden number. A company with returns on equity of 15% or above is a great company. Quite often you might see it maybe 10%, but I like to have high standards. And a lot of with these pillars, you're not going to get every single box ticked because that would be just the best company in the world. So yeah, the return on equity, I like to look for 15%. So now on Morningstar, as you can see, return on equity, 2016, 15, 2017, 9, 2018, 19, 2019, 18, 2020, 19. So you can see from Google, generally their return on equity is above 15, and it's the past 3 years it's been very consistent, and that's something else I like to look for, consistency with their financial performance. So yeah, Google, Alphabet, I'll use them synonymously in today's video, so just deal with it. Google, great return on equity, fantastic. The next one we look for is long-term debt over equity. Essentially what this is how much debt do they have compared to equity within the business. I like companies which use equity to grow their business, so they are not using debt or finance to grow, because debt is bad generally, especially for businesses. The more debt you have, the more fragile you are, and if anything goes wrong in your business and you have a few years of unprofitability, because it can happen, your business could go bankrupt if you can't make your payments and interest payments. Simple as. So for safety and for quality of business reasons, I prefer low debt. So let's have a quick look at long-term debt to equity. I think on this one we're going to have to go to Macrotrends. Macrotrends, what's good about Macrotrends is on their website they have all the key financial ratios already done for you, so you don't have to calculate them. And this is one thing I like for a time-saving purpose if you're looking at various companies. Let's have a look. So long-term debt to equity, yeah. So on the screen it's showing long-term debt to capital, and it's showing 0.06%. And what do I look for? I look for anything for 50% or below. So Google smashes this out the park. They basically have no debt, especially when you consider their cash balance is over 100 billion. This is a tick, and you look at the previous years at Google, It's a very minimal amount. Don't even know why I'd have it, to be honest. It's pointless. Hey ho, there's probably some sort of reason for it. But yeah, Google lets you tick for this. They basically have no debt. Fantastic. Winner, winner. The next one is current ratio. So what is the current ratio? This is basically the current assets over the current liabilities. So I want the current assets of the business to be worth more than the current liabilities. So this means they can meet any current payments, essentially. Any payments within a year, they are covered, essentially, because current assets is like cash, stock, debtors, and then current liabilities is like your current payables and loans within 12 months, etc, etc. So let's have a quick look at, I'm back on Macrotrends, let's have a look at Morningstar. Do they have it? Yeah, they do. They have the current ratio. So 2016 was 6, 2017 was 5, 2018 4, 2019 3, 2023. Oh, sorry, I didn't explain. I like it to be above 1, essentially. I think they need to at least cover your current liabilities. Let's have a look at Macrotrends as well to confirm that. Yes, spot on. So Google has got plenty of assets on hand to pay for any current liabilities. So I think it's safe to say on this basis that Google have passed Pillar 1, they are profitable, they have high returns on capital, and they use low leverage to do that. Google has passed this test anyway. Pillar 1, all sorted. So Pillar 2 is people managing the company with equal measure of talent and integrity. Essentially what we're doing in this pillar is we are analysing the management and the leaders of the company, so the CEO, CFO, and maybe even some of the owners, because they do have a very big influence on the company itself. So let me just put it out there, there's no magic formula for qualitative analysis. So there's no ratios involved with this, there's no numbers, it's all to do with reading about the owners / management, reading the financial statements of what they have written themselves, and then coming to the conclusion if you think they are making good decisions. A lot of the time you can work this out through the numbers, because if the numbers aren't good, it kind of shows they're not very good as management. But one thing you need to do is you do need to read a bit about management, look into their history, what have they been doing, what is their history, where have they worked before. One thing I do like is I like CEOs who have been there for a long time, because quite often it means they're doing a good job and the people at the company like them, the board like them, etc. A good example of this would be Bob Iger at Disney. He was there for a long time, and he's someone who I think was a great CEO. He's now the chairman, I believe. So yeah, let's get into it. So length of tenure, like I've just mentioned, you want them to be there for quite a long time. Strategy and goals. Strategy and goals, what you want to be doing is you want to look at the annual reports. So let's have a quick look at the 10K at Google, Alphabet, sorry. Just use it, all the same thing, to be honest. Best thing to do is look at the contents page, have a look around, management's discussion, analysis, boom, let's go there. You can have a look at what they've been talking about, have a look at the what management has been discussing, and what's been going on in the business, what their mission statement is, what they plan to do with the business going forward, talking about the results and if that reflects what happened with the numbers. Make sure they're not sugarcoating things, make sure they are, have integrity. And then what you can also do is, with what they're saying, you can work out if they have, if the talent's there as well, if they probably know what's going on with the business. So that's the best thing to do, is look through the annual reports, read what the management is saying. There's not much more you can do on this. You can look at what other investors have posted online about the company. You might get some insights, but the annual reports, 10K, is the best place to be honest. They're quite long, but thankfully we've got these content pages, so you can find them. It is possible to navigate them, you just have to get used to the system. I didn't really go into the founders of Google themselves, so let's have a look. So Sundar Pichai is the CEO of Google. How long's he been there? I think he's been there since 2015. I might be wrong. Just have a look on Wikipedia. I think it'll tell me. let's have a look. Yep, it was Larry. He replaced Larry Page in 2015. Sundar Pichai is the CEO of Google. One thing I would do is I would research, look on Wikipedia, research him, see what his history is, and I can see he's been at Google for a long time. It's another bonus. In Google's case, looking at the founders is important, because one thing you'll need to understand with Google, for example, quite a few companies are like this. The two founders of Google basically have all the voting rights. It's the same as Facebook. So let's say at Google, the share structure work, they've got 3 different classes of share, A, B and C, and the founders own all the B shares. So for each share they have like 10 votes, and the other shares, I think it's A shares have 1 and C shares have 0. So they basically have less shares than everyone else but have all the votes over 51%, which is what you need, or 50.1%, whatever you want to say. So I would say in this case that the founders of Google are important as well, because they have ultimate influence over the business. So Larry Page and Sergey Brin, I'd do research on the founders of Google. In this case, I would, work out what they're up to now, what their goals are, because ultimately what they want is what's going to happen if they own most of the voting shares. So that's one thing I would look at. Next one would be insider buy-in. So in terms of Google, let's just pop on to Yahoo Finance. I think this is quite a good way to look at insider buy-in. Let's have a look. Holders. That's where we go on Google, on Yahoo Finance. There we go. It's taking a while sometimes. Insider roster and insider transactions. You can see, you can see when people have been buying. So when the board, they have to disclose this essentially. When the board or the CEO buy or sell shares, they have to disclose that because it's quite sensitive information. So for example, if the CEO just sells all the shares, it's not looking good for the business, is it? So that's one thing they do, is you just have a look around at how many shares they've been buying. What you want to be looking for is you want to see the CEO and the board buying shares constantly, because what you want is them to be invested in the company themselves. Because what I personally think is, so if someone has a lot of their money in the company they're working for, they are going to have better integrity, they're going to want the company to do well. So this is a very important point for me. It's a very simple metric to look at. And another one will be compensation. So how much are they getting paid? Is it reasonable, in line with expectations? Yeah, so you want to make sure the insider compensation is reasonable. So you can find this on the financial statements, how much the CEO, etc. is getting paid, and what stock options have got, incentives to do well. So very simple. You just need to make a decision if you think the management and the founders of the company, sometimes interlinked, you need to make sure they're good people, and this is quite an important process, because you need to make sure the people running the business which you are owning are good people. So in this case, I would say Google have good management. Their financials are showing this. They are growing pretty rapidly still at a good rate for a massive business. And yeah, in my opinion, from the research I've done, Google do pass a management test. So that's pillar 1, tick. So pillar 3 is reinvestment opportunities and room to grow. So what we're looking for in this one is revenue growth, free cash flow growth and profit growth. And then alongside that, previous acquisitions, dividend growth and decrease in share count. All of these come into one, in my opinion, and you need to be seeing more of these than others. So let's have a quick look. So the first one, let's go for revenue growth. So looking at Google, I think it's pretty fair to say, sorry, I was on the wrong page there. I'll just get the income statement up on that side. So revenue growth, you can see year on year, fantastic. It was 20% a few years ago, and we're now looking at closer to 18, 12. Basically means they're growing as a business, so the revenue is a lot harder to keep up growing. So you still want to see their revenue growth consistently grow. For older businesses, you want to be seeing at least in line with inflation. I always like to see at least 3 or 4%, just above inflation, because quite often this will mean they have pricing power. So each year on year they can increase their prices. So let's have a quick look. Look at the numbers. Yeah, you can see obviously the numbers are growing quite nicely. which is exactly what you want to be seeing. So simply, that's a tick. Revenue growth done. Free cash flow growth. Let's just get the cash flow statement up. Yeah, we're looking at the cash flow. So yeah, you can see the growth is consistent, consistently growing. Free cash flow growth is also fantastic, apart from the blip in 2017. So yeah, pretty happy with this. Let's just have a quick look at the cash flow statement. Yeah, cash flow is growing. You'd expect this. If their sales are growing, you'd expect their cash flow to be growing. So it's a very simple tick. And then profit growth. Let's go back to the income statement. Yeah, let's have a look. Operating income. Yeah, you can just see that growing as well. Easy enough, simple enough. You just want these figures to be growing because that goes in your favour as an investor. If the company's making more and more money each year, that's only good for you as an investor. So that side of it, it's all good. The next side, the room to grow side, I think we've proven that we have grown, and we've proven that we can probably grow into the future. Reinvestment opportunities. This is another very important topic. So the number one for me is decreasing share count. This is probably the most valuable thing for shareholders. Essentially, all this means is buybacks. So what you want over time is the shares outstanding to be decreasing. So what we can see from here is Google's share count is slowly decreasing. This is on Macrotrends, by the way. I do flick through the different tools quite often. So what we're seeing here is, as I've just said, is we want their share count to be decreasing, and it is year on year, or quarter by quarter in this case, I think it is. Essentially, why does this benefit us as shareholders? Well, when the company buys back its own shares, it decreases the share count, and then in theory, that means the shares outstanding are worth more because there's less shares. Basically, that's what it means. It's very tax efficient because there's no tax to pay on share buybacks. And this will come on to the next point of dividend growth. Google don't pay dividends, so there's nothing to show here. And this is because the founders have been the board and the company itself have been reinvesting their profits into Google instead of paying a dividend. And they think the return on paying a dividend is less than what they can return in general, like internally. So yeah, pretty simple really. If the company had dividends, you would want to see their dividends growing year on year, which Macrotrends does also show, and you'll be able to see online as well what the dividend per share has been, or the total dividend paid. That's a better figure to use. You want this to be growing year on year. And then the number three will be previous acquisitions. So what you want to be doing is you want to go on Google. Let's just have a quick Google now. Google previous acquisitions, or recent acquisitions, whatever you want to call it. Fitbit, recent acquisition, that shows £2.1 billion in 2019. Fitbit for watch brand, for fitness people. What else? Motorola Mobility. Oh wow, okay. So yeah, they bought Motorola in 2012, but then they sold it a few years after, which was a bad move, it seems. Yeah, because I think you can see it here on Google. That's a bit better. Literally just go into Wikipedia and type this in, you'll see. Key acquisitions. You can go back quite a few years. Let's just say YouTube is probably one of the best acquisitions in history, because I don't know how much profit YouTube makes. You can work it out, but they'd probably be a 2 billion market cap company on their own YouTube. They're that important to Google. What else we got? We've got different types of companies. We've got Waze, we've got DeepMind Technologies. So you want to be looking at different acquisitions and looking if they've been good or not. Google being as big as they are, you're not fully going to be able to tell. But what I would look for is the biggest acquisitions, have they been good? Motorola, clearly a fail, clearly a flop, bad acquisition. YouTube, fantastic acquisition. So you need to be looking at what have they been buying, and has it been worth it? So yeah, and how has it gone into the business? So yeah, in terms of reinvestment and opportunities and growth, Google ticks all the boxes. Their revenue's growing, their cash flow's growing, their profit's growing. What you want to be making sure is when you're doing your discounted free cash flow valuation, which we'll come on to, is you want to be making sure your figures are reasonable. And as Google's a growing and maturing business, you want to make sure that these figures are, reasonable going forward and not too over the top. And yeah, previous acquisitions, I'd probably say Google passes that test. Dividends, we can't say because they've never paid a dividend, and I don't think they ever will. Decrease in share count, they're passed. So overall, this is fantastic. The pass pillar 3, plain and simple. So yeah, now on to the 4th pillar, and the most important of all is you want to be buying a company at a fair price. And to determine this, you want to be using the different price ratios, and as well as that, ultimately at the end of the day, doing your discounted free cash flow valuation to determine the fair value of your stock. So the first one I will be looking at is a simple one, PE ratio, a very popular price ratio that people use. Generally, you want in your PE ratio to be lower than 20. This isn't always the case, as you'll see with Google, because when a company is growing more, you can allow for a bigger PE ratio. So let's have a quick look at the PE ratio of Google on Macrotrends. Here. So we could see that, when's that? Sorry, it's American dates, it's thrown me off. Before the 9th of April, 39. So for me, that is extravagant, way too high. But you can see back in March 2020, the PE ratio was 23. So for a company like Google, this is probably very, very reasonable. And people who bought in March 2020 have done very well, and fair play to them. I'd be looking for this to go to at least 25 before I start buying, most likely. But who knows if that'll happen. The market is just a bit mental as of today. Right, let's go to the next one. Price to free cash flow. I also want this to be below 20. So let's have a quick look. Once again, it's at 38. And the last time it was below 20 was 2019 actually. So the price to free cash flow works into the discounted free cash flow quite well because they do interlink quite a bit. It's just a generalization. If you see it at this level, you probably want to be avoiding. But ultimately, the value of your stock comes from your discounted free cash flow. So what rate of your return you want and what cash flows you're predicting the business will return. And in the next video, which will link onto this very well, we will go through the discounted free cash flow valuation using the template, which I'll be giving out for free. And ultimately, like I keep saying, that is the best way to value stocks, through that valuation method. But overall, Google has passed all 4 pillars. They are profitable, high returns on capital, low leverage, tick. Pillar 2, the people managing the company with equal measure of talent and integrity, instant tick. Number 3, reinvestment opportunities and room to grow. I still think they have room to grow. They're going to become a mature company, which you have to take into account. But also, they have plenty of reinvestment opportunities with over $100 billion in cash, decreasing share count, and a very dominant business with a large moat. Then number 4, buy at a fair price. They don't meet this one, but when they do get to your fair value, they will hit it. So 3 out of 4 they hit. Quite often, pillar 4 will be the stumbling block because you don't buy overvalued stocks, you don't buy overvalued assets. It's not how you make money. So anyway, there we go. I hope that makes sense what I've gone through. If you want to look at the different websites I use to analyse stocks, I will leave them all in the description below, all the resources. Morningstar, Macrotrends Yahoo Finance, and yeah, we'll go from there. I'll be doing many of these videos going forward, sitting down, going through the stock analysis. I know this is very unraw and uncut, but I think this is the best way to learn when investing in the stock market. So there we have it. That is how to analyse stocks in a very basic and quick manner. I hope you really enjoyed the video and understood it in full. Any questions at all, please leave a comment on the video, or get in touch somehow. Email or direct message is always best. And if you want to learn more about investing, please subscribe to my new newsletter, which will be coming out this week. I will be having all sorts of free, great content on there for fellow investors. And if you want to get some investment books relating to stocks, head over to my recommendations page over on my website, where I have a full library of books I have read / recommended from other people, relating to finance, business, investing and personal development. As always, if you enjoyed today's video, please like and leave a comment, as it really helps my video get out there to more people. And if you want more investing content, please subscribe to the channel. Thank you very much for watching today's video. I will see you next time.